Today we're going to talk about momentum trading and high-speed trading. The trading technology of today is absolutely mind-blowing. I mean, we optimize everything. The things we're doing on Wall Street will absolutely blow your mind. I mean, every single component we optimize. We're concerned about the cable length in the data server. We're concerned about the distance between your server and a trading client. In modern trading, we're using things like kernel bypass, where we're skipping the OS kernel, going straight to the RAM, and then you have event-based functions that are looking for this event, responding immediately. Modern trading is in the world of nanoseconds, microseconds, and milliseconds. It's all about time. And one of the reasons for this is something called momentum trading. So momentum trading is basically trading psychology, and it's also trading strategy. So it is a trading psychology that is exploited by the trading strategists using momentum trading strategies. And what it's all about is momentum. It's in the name. You're looking at changes in volume. You're looking at trends. You're looking at patterns. So you're looking at a price change. A price is moving in a certain direction with a certain level of consistency. You're looking at volume spikes. So that means you have a lot of people that are doing things. I mean, when you're looking at market data, what you're really looking at is you're looking at the crowd. And momentum trading is all about the crowd. It's exploiting herd mentality. You got some news report that comes in, Apple's about to release some new product, you see it in your Bloomberg terminal, and some clever traders, rightfully speculate that there's going to be a surge in the price of Apple. And because they have this high frequency trading systems, they can send those orders to get executed in a blink of an eye. Much less than a blink of an eye, actually. But they're not the only ones, right? So that's where things like making sure, if you're a service provider, making sure that all of your clients have the exact same length of cable so that one of your clients doesn't have a nanosecond advantage, which could mean the difference between being first to market and not. Momentum trading is, in terms of strategy, it's a strategy where you're looking at trends and you're trying to ride the wave. Right? Like that Apple event that's coming out, you're expecting a wave of, news and people jumping on board. Trading begets trading, right? Just to clarify, I want to separate the speculators from the momentum traders. First, we're starting with the speculators, who are the first to market. They're the ones who are at the leading edge of what becomes the momentum, which the momentum traders react to. So the speculators put in their orders, a bunch of them start the initial energy, the initial momentum. They enter their orders and all their people enter their orders, and there's sort of a herd mentality. The momentum traders are looking at certain indicators that are signaling that there is some momentum occurring at which they can profit from. So they jump in the middle of this rather than at the beginning. First, you have the initial group of traders entering orders. You have other people that are observing this activity and jumping on. And then you have the momentum traders who, as a strategy, are reacting to certain indicators. And the indicators are the waves being created by all the people who are first to market. And then in the context of high-speed trading, the momentum traders will jump in quick and jump out quick. Jump in, take profits, and then exit.
Some of these traders are using algorithms that use historical data to basically sniff out the early signs of a potential surge, right? They're able to smartly identify the differences between a random surge or a fleeting surge, as opposed to something that is more long-term, at least on the day, and to also predict the optimum entry point to jump on the surge to get those profits. We're using things like machine learning, where you can train the software to know the difference between random spikes versus something that has a little bit more energy to it, which could be 2 to 3 hour surge, or maybe the entire day. The stock could move either up or down drastically. Basically what we do is we would train the software by showing it a lot of historical data, a lot of spikes. Look at this spike, look at that spike. And it has a lot of examples where the spike actually was real, meaning the stock was about to shoot for the moon. And it has a lot of data where the spike was just short-lived, such that the software is able to predict which spike to jump on and which ones to ignore. I mean, if I could tell you the crazy things that they're doing right now, it would absolutely blow your mind. I mean, the technology is just getting so out of control. Skynet is here. We've got algorithms that can even do things like play games, do certain tricks to get people to reveal their hands. And also, we're able to train the algorithms to basically sniff out certain tricks that other traders might be utilizing. So there's certain moves that traders will use, It's kind of like a chess game, and the algorithms can be trained on these tactics so that they can outsmart the competition. Now, obviously, everyone's trying to do this, but the smartest algo and the fastest trading system wins.
And you anticipate that. You place your orders, and you have people on the sidelines that are watching. When they look at their market data, they see the volume spike, which you are a part of, right? They are seeing your orders moving the market. All this spike in trading activity inspires more trading activity. So you enter the market because you see somebody else enter the market, and somebody else enters the market because they see you enter the market. And it's a snowball effect. But unfortunately, there's another side to that coin, and that is, imagine you're chasing your kid and you're running full speed, and all of a sudden the kid changes directions. You have no way of anticipating that he's gonna do that, right? So guess what you're doing the instant that you recognize that they've changed direction? You're still going in the wrong direction. You're still full speed going in the wrong direction. Why? There is latency, right? There is that timestamp where you observe the change in direction of your kid, right? And then there's that delay while you have all that momentum pushing you in the wrong direction. You're still running in the wrong direction. You need time to wind down that energy and slow down. You've overshot. And this is an effect that's going to typically happen with momentum trading. You have all this frenzy and fear of missing out. People want to jump in and get on the action, and everyone's all excited. And at some point in time, you're going to overshoot. The price is going to go too far. And that means what's coming next is a reversal. My name is Carlisle, and I've been in investment banking for 24 years. I've seen it all. I've worked for some of the largest and most successful global investment banks in the world. I've overseen as much as $3 billion worth of orders in 15 minutes going out to the market for the closing auction, OMS, EMS, algorithmic trading, quantitative. My journey started when I was probably 21 years old, and I was working in a laptop store, retail store, and I would go to work in a suit and a briefcase, carrying the Wall Street Journal or the Financial Times. It's been a long, exciting journey, and on this channel, I share all the things that I've learned in my 24 years working in investment banking. I started this channel about 2006 with one goal in mind. I wanted to help others to learn the things that I had learned, things that I personally struggled with just based on the type of material that was out there to learn from. The philosophy was always to make learning fun, to simplify complex topics. And that's what I do here on Carlisle Speaks Wall Street. If that's of interest to you, you know what to do. I look forward to reading your comments and hearing about your story and your journey to success. Join our community, reach for the stars, live your best life. And one of the reasons for that reversal is, again, back to our high-speed trading guys who were the first to market. They were the speculators who anticipated all this momentum. They jumped in early, but they're day traders. They have a very short trading window. Maybe they want to hold their position for an hour or two. So the price surges up 5% in a few hours, and based on their strategy, these are the profits they were looking to get. As important as your entrance is your exit, right? Jumping in first and then jumping out last, no good. You're riding a wave. You don't want to crash with the wave. You want to ride the wave, stay on top, and you want to exit on top, right? Buy low, sell high. Problem is, a lot of these guys are big players putting in large orders, and there's a bunch of them. So when they back out because they were just doing a short-term move, it's going to move the market. It's going to generate something called momentum in the other direction. Price was rising, volume was rising. Volume's still high, still a lot of activity, but the direction has changed, right? And it's changed drastically because you have this unnatural movement. Nothing happened with the company. There's no new news. You just have all these traders that are pulling out of their positions because they already got their gains, right? Then the rest of the market is reactive. They're responding to what they're seeing in their market data. They reacted to a surge, seeing the prices going up, seeing the volume going up, and now they're reacting to a surge in the other direction. Oh, people are selling, it's gonna crash, right? So when you close out your positions, the big dogs and the high-speed trading, doing your big trades, big moves, then all the rest of the market, not all of them, but a lot of them are gonna follow. They're gonna panic. Oh, it's crashing. So selling begets selling, buying begets buying. That is momentum trading. For some people, it's a strategy in terms of they're aware of these dynamics and they exploit them using strategies. For other people, you're just part of the herd. You're just reacting to market moves. A lot of it's emotional based, and that's not good in trading. You want to act in a very strategic way, very logical way. You want to have your strategies and follow those strategies, and don't let your feelings get in the way. A lot of trading, there's a lot of emotions, right? So when you back out with your profits and other people want to back out, and that pushes the price back, you get a reversal. Another factor you have to consider is algorithms. Today, we're doing amazing things with algorithms in electronic trading. We've got machine learning and artificial intelligence, where some of these algos are pretty smart and are able to sniff out certain things. For example, that reversal. Maybe you're using an algorithm that's not so smart and it panics, not literally, but it sees this reversal and, oh, sell, right? but maybe a smart algorithm using trend analysis, historical patterns, math, quantitative analysis, they are able to stay on top of the game. Maybe they jump in early, and maybe you reduce the size of your position at the right moment based on certain indicators that are predicting a reversal. So rather than just sell everything, it's let me minimize my exposure. Let me minimize my risk. Let me reduce my position size. I got 1 million shares. Let's sell 500,000 shares, cutting my risk in half, right? I got a 6% gain on the day, 6% gain on 1 million shares. I cut my position size to 500,000. Maybe the reversal is just 2%. So I took a 6% gain on 1 million shares and a 2% loss on half the amount of shares. So the net effect, I'm doing pretty good, right? Even if I didn't sell any, I would still be doing pretty good. But the fact that I sold half my shares minimized the effect of the 2% reversal. And this is why speed trading, we are so concerned about speed, right? We want to isolate CPU cores to our trading applications, dedicated access. We want to use local memory, using UMA strategies. We want to utilize local memory as opposed to remote memory, meaning we're always concerned about time and distance, right? The memory that's closest to the CPU is going to allow us the fastest performance. So NUMA, not UMA, is non-uniform memory access as opposed to UMA, which is uniform memory access. Basically, in high-speed trading, we utilize multiprocessor servers. And with a multiprocessor server, the hardware groups the processor with what we call local memory. So the idea is each processor has some memory that is closest to that processor. And therefore, for maximum performance, you write a NUMA-aware application that will utilize these nodes, which again is the groupings of the processor and the memory. So basically, if you want to do some complex analysis on some data on a bunch of orders, large data set, you store them within this node, so the memory, the local memory for that processor, and then you use that processor, which is closest to that memory, to process the data. Now, the alternative would be you could store the data in memory that is closer to other processors, but then you're going to introduce latency because there's an internode delay where you're trying to communicate with data that is further away from the processor that is doing the processing. I am telling you, you have no idea how extreme things get in modern trading. Every single aspect of the trading system is optimized for maximum performance. And there's so many things that are on the horizon, from quantum computing to edge processing, and we're going to talk about it all right here on this channel. We want to get the trading client as close to, or at least we want to minimize the distance from the trading server to the trading client. We want to pick an efficient path, right? We want to use the right cabling. We want to be concerned with certain scientific principles like EMI, electromagnetic interference. We want our servers co-located on the exchange floor, cutting the distance between our trading server and the exchange server. Every single aspect of the trading system today, we optimize for speed and ultimate performance, because trading in 25 is all about speed. Now, I will talk a lot more in depth about trading technology and high-speed trading and optimization techniques and programming languages in terms of which ones are the best ones to use today in my full deep dive on electronic trading. It's a series that I'm working on, and we're gonna go deep. You're not gonna wanna miss out on that. So if that interests you, whether you're a developer, application support engineer, you're a business analyst, or you're just a nerd like me that gets excited about technology, you're definitely gonna wanna stay tuned for that series right here on Carl Speaks Wall Street. If you enjoyed this video, you know what to do. Click on the like button, subscribe, smash that bell. This is Carl Speaks Wall Street. Join in on the momentum and subscribe right now. See you soon.